Steve Weiss, Barclays today, speaking about the competition that has existed elsewhere. It's been well documented. We've talked about it for a year. Josh just highlighted the cash side. There's also the bond side of that, where Barclays today says, quote, stocks are more appealing than bonds at these levels. We expect the world economy to slow in 24, but in a fairly benign fashion, with low peak jobless rates and further declines in inflation in the major economies. This is not an outright soft landing, but it is distinctly soft-ish. Are stocks now more appealing than bonds for the first time? Can we make that statement, Weiss, in a long time?
Yeah, I think they're getting that way. Not entirely. I mean, you know, we've seen the 10-year of a major move, but the 2-year, the short end of the curve, still, you know, gives you good return for the short end. But let's classify it. It's not as if everybody goes into bonds because they think it's a better return. So there are two segments. So the ones that go in there, they go there to hide, and I did some of that. You know, I'm not happy. I'm not getting up every day to generate, you know, 5% return on 2-year money. So I did it as a place to hide. I thought it was a good return and a good place to hide. That segment is most likely to come back into the market at the right time. Then there are the others who say, you know what, I can live with 5% on a treasury or 6, 7, 8% if I'm willing to take a little risk in the balance sheet. And I can be there for a long time. After all, actuarial, you know, projections for endowments are 7 to 8%, right? Typically, so that's fine. So if you have more of that capital, excuse me, that's going there to hide, it will come in. I think the market's okay through the end of the year, data dependent. So if we continue to see weakening data and it accelerates to the downside, then that's a different story. But right now, you know, the baseline story is the Fed is done. And not only that, the market's taking care of itself in terms of rates coming down.
Weiss, you grab a little drink there. Give your voice a rest. I'm going to go to Bryn for a moment because Bryn, Weiss sets this up perfectly where he says, you know, this is the Fed is done. That's what this rally is all based on, isn't it? The narrative is the Fed is done. The risk in all of that, of course, is that the market's made the mistake before of getting too dovish. Is it doing it once again?
Probably so. I think one of the bigger drivers, though, in addition to the narrative that the Fed has done, is the 10-year's gone from, you know, close to 5 to 4 or over 5 to 4.5, right? And so you've seen that really big sell-off in bonds, which has been just like lit a fire on pretty much stocks in aggregate. I think that the Fed can be done. And what's not priced in, though, is higher for longer. And when we don't know that, because I know people are saying, oh, yeah, we can handle 3 or 4% inflation. But Jay Powell has been crystal clear that he wants 2. And we're still incredibly far away from that. And so I think still that unknown of higher for longer is what will potentially trip up a rally much higher than this. I also think that we're going to continue to see, you know, very, very large treasury auctions, and I think that will continue to actually take more of a front seat than is the Fed done or not done, and what happens on the longer end of the treasury market. You know, talking a second about cash versus bonds, you know, I think that bonds are a way to grow poor safely. And if you think about the trillions that went into money markets this year, I think it's 6 trillion or over 6 trillion now. I think what's interesting about cash right now versus bonds is you have about a 90 basis point pickup versus money markets versus the 10-year. And so even if the Fed cuts rates, you're still at a higher return of cash than bonds. And so I actually think that money market dollars will be a little bit stickier than people think because you're going to get a higher yield for longer than going longer on the curve.